Today we're here with Sean, who's very excited to be here, and Adam, who's equally thrilled to talk about ratios and the DuPont method. So let's dive right in.
All right. From what I understand, you guys have come up with a little memory jog here, known as PEL here, which is profitability, efficiency, liquidity, and leverage. Just briefly, profitability is going to be most of your return ratios, correct, Sean?
Yes.
As you look through your sheet, you should see these. Efficiency, that's going to be how quickly it's going to be your turnover or your average sort of ratios, average collection almost. That's one of them, I believe.
Your collection period, whatever.
Period. The third one here is liquidity. Those are
your current.
Most of your
quick.
Yeah, which has to do with liquidity, the concept of liquidity.
Test, whatever you want to call it.
Yep. Last one being leverage, which deals with capital structure.
Very good.
So the first one here, profitability. Sean, what's the most important profitability when you think? And just talk about it just a little bit.
What I was thinking is that we want a high profitability ratio at all costs. So 3 examples of them, I could say return on equity, return on assets, and we also have return on capital. But I'll let you talk about ROE. That's probably the number one.
Return on equity, you can think about it as we have a certain amount of equity, as we refer to it, invested in our firm. And the return on equity ratio looks at how much net income we are generating from that equity that we have invested. And like Sean said, in most situations, the higher the number is compared to the competitors relative to the industry, the better.
So, I have a nice example with that. Say we have $100 in equity, and our net income is actually $10. That means we're actually earning that 10% on that $100 that we had invested. So that's an example of ROE. So when we think of profitability, we want to think high. Okay, always high. So let's move on to efficiency.
Okay, efficiency. We're going to take a look at how well we are applying our resources to
how efficient we are.
Right.
Our operations. That's
right.
What we're looking at.
Right. A lot of it has to do with turnover. An example would be the inventory turnover. For manufacturing, we have an inventory. It takes a look at how long it's sitting in our warehouse before we move it. In some situations, it's the ratio. What would you say? In general, it'd be better to have it.
Well, when we talk about turnover, we want turnover many times in years. So when we talk about especially inventory turnover, so the higher the inventory turnover, the better. But if we talk about days in inventory, we want that to be actually really low because, so we'll talk about average days in inventory, right? So if I say, Adam, you flip over your inventory every 5 days, as opposed to me flipping over my inventory every 10 days, I'd rather be with you since you're flipping over your 5 days.
Right.
But that's why we talk about the other side of it, turnover. If you're going to be flipping that a lot more times, which is actually what that ratio tells you. So that's why if we talk about just the turnover ratio, we want that to be high.
Right.
So, I mean, I think we're pretty good. Lori, what do you think about that?
I think you've nailed it. Let's keep going.
All right, that's
all right. Moving on to liquidity here. We can go ahead and take a look at our current assets and current liabilities almost.
That's the current ratio right there.
Right.
Current assets and current liabilities.
Right. Liquidity, you're probably familiar with the term. It's just we're going to take a look at how quickly we can convert what we have in assets into cash.
Yeah, no, exactly.
That's kind of quick.
And technically we want to be around 1, so that 1-for-1 ratio. We would like to be above 1, because that means we have more assets than our liabilities. So banks would actually be really happy to see that as well if we're talking about loans and whatnot.
But just again with that, it's all going to be relative to the industry that you're in. So when you're comparing, for example, any of these ratios, but with liquidity, compare a firm with its competitors and then the average in the industry to get a better look at, just to get a better picture of how they're doing compared to others who are in the same business, right?
Yeah, exactly.
All right, and finally leverage here, the last L. This is going to be essentially their capital structure, how they go about financing their activities.
Whether debt or equity, you have two big decisions that you can make. If you're a company, you can either finance through your debt, which means you're going out and getting bank loans or you're issuing bonds. And then equity, as you guys know, if you want to go public, you can have an IPO and then you're publicly traded. And if you need even more equity, we do what is called a seasoned new issue, and that brings revenue, well not revenue, but brings cash into the firm.
Yep.
And so that's two ways. And there's no set number on our leverage ratio. I will tell you that in good times, having more debt than equity is probably a good thing, because debt is very, very cheap relative to our equity financing. But when times are bad and you're strapped on cash and you have a lot of debt and you're looking to get more debt from a bank, they're probably not going to give it to you. So you might actually want to have a bit more equity than debt. So that's a very fine line that we walk.
Right. Yeah.
So that's
essentially it'll make good times great and bad times terrible.
Yeah. That's the best way to put it. So with all that said, should we move on to the DuPont method?
Shall we?
So Lori, you want to take us over to the DuPont method here? And as you can see, our DuPont method is in 3 ratios. So that first one, net income over sales, that's actually our net profit margin. Our sales over assets, that's our total assets, or turnover, total asset turnover, sorry. And then our assets over our equity, as Lori always refers it to, ACE, assets to common equity. So let's talk about net profit margin. So that's kind of like a profitability ratio as well, right?
Yeah, you could think of it in that way. This is what you're bringing in total by doing business, and this is how much you're actually putting in your pocket. I mean, yeah, essentially.
The percentage of sales.
Right.
That you put in your pocket.
Right.
So we want that to be high, which is very important. So the higher the better. When we look over sales to assets, that's a turnover one, so we want that to be as high too. So the nice thing about the DuPont method is you can see how management can come in and dissect their company just between 3 ratios even. And that's the best example is talk about DuPont method. Lastly, assets to equity, that's kind of a capital structure one right there. Because when we think of the balance sheet, right, that's kind of what it's telling us, because assets is on the left side, equity is on the right, but that portion that's not included there, liabilities, that's the difference between the assets and equity. So that's why you can see that that's completely a capital structure ratio.
Right.
So that's one that's up for grabs, and how you want to comment on it, I guess you would say. Do you have anything to add?
No, it's tough to kind of. What would you say for rule of thumb with that one? I mean, we said this one's good to be higher. Same with this.
Rule of thumb. I would be happy with probably around 1.5. What about you, Laura?
I think as high as possible, because of course you're trying to stretch your equity dollars.
That's true.
But you need to be prudent about how much debt you take on to be able to do that.
Yep. So that's how management can work on things.
Thanks, gentlemen.
Yep. Thank you.